The cost of you missing out on this video or not watching it till the end could be upwards of hundreds of thousands of dollars in interest payments over the course of your entire lifetime. In fact, a person with bad credit will end up paying over $100,000 more than a person with excellent credit for the same $300,000 30-year mortgage on a house. And that is only if the person with bad credit is fortunate enough to get the loan in the first place. Having bad credit can keep you away from buying your dream house, financing your education, and sometimes from getting the job that you want. And that's why after watching this video, you'll understand what credit is and how it works, what factors are used to calculate your credit score, and what are the things that you need to start doing to improve your credit score fast. And for those of you who don't know me, my name is Ricardo, and every week on this channel I release a new video to help you out with your personal finances. So if you want to be notified every time I upload new content, don't forget to hit that subscribe button. So coming back to the video, let's start with what credit is and how it works. Credit simply is receiving something of value now and promising to pay it at a later date. Lenders, merchants, and service providers grant you credit based on their confidence that you can pay them back what you borrowed along with any interest charges. Borrowing money is as old as civilization itself. You see, hundreds of years ago, the only way for lenders to know if they could lend you out money was through personal recommendations or personal relationships. But today, lenders prefer a more objective approach. In the US, for example, they look at your credit reports and your credit scores before actually deciding if they're going to lend you out money. Based on those two factors, your credit report and your credit score, the lender's going to determine how much should they charge you for the loan and if they're going to approve you for it or not. So whether you're taking a loan to pay for college or to get a new car or buy a new house, credit scores are super important. But a couple of days ago, I came across this article by CNBC that really surprised me. According to the article, 4 in 10 Americans have absolutely no idea how their score is calculated or what actions they need to take to improve their scores. So if you're part of that 40%, you might be wondering what factors are used to calculate your credit score. In the US, there are 3 main credit bureaus. First, you have Equifax, then TransUnion, and Experian. And they're in charge of gathering all of your financial information and they use it to dictate your credit score. Each credit bureau puts out a credit score which can range anywhere from 300 points to 850 points. A score below 650 is most of the time considered problematic, while an excellent score of 750 or above will get you the best interest rates available in the market. But if you're looking to qualify for any loans, your score should be above 700 points. Now, your credit score is based off these 5 factors. 10% of your score comes from your credit mix, or in other words, your type of credit. Your credit mix is based on how many different types of accounts you have, being it mortgages, car loans, installment loans, credit cards, you name it. The next 10% is based on your new credit. This category looks at how many inquiries you have, meaning how many times have you applied for credit in the last 24 months. Statistically, if you're seeking out a lot of new credit in a short period of time, you're going to be seen as risky by lenders, which in the end makes your scores go down and your interest payments go up. Credit bureaus check this by something called hard inquiries, which is a term for any time that a lender goes out and checks your credit scores. The next 15% of your credit score is calculated by the length of your credit history. The length of your credit history is based on how long you have had your credit accounts open. The fourth factor is the amounts owed, which is also known as credit utilization, and it represents 30% of your credit score. This is the second most relevant category, and it evaluates how much of your credit limit you're using every single month. The final and most significant portion of your credit score is determined by your payment history, which accounts for the remaining 35% of your credit score calculation. This is the most important aspect of your credit report, and it shows if you paid or haven't paid your credit accounts on time. Okay, so now that you know the 5 factors that make up your credit score, let's dive into each one of them so you know exactly what you need to be doing if you want to improve your credit scores. I'm going to start with the factors that have the biggest impact, and then I'll move toward those that are still important for you to monitor but have the least impact. Let's start with your payment history. Typically, if you pay your loans and your credit cards on time, that's a good sign for lenders that they can rely on you to make future payments on time. Your payment history is calculated using the following formula. You take the number of on-time payments and you divide it by the number of total payments, which is going to give you the percentage of payments that you made on time. So let's say that you have had 5 credit cards for the past 6 years and you only missed 2 monthly payments during that period. That means that out of 360 total payments, you made 358 of those on time, which ends up being 99.5% of your payments made on time. And according to Credit Karma, that's gonna land you in the top standing rating. But on the other hand, if you have had only 1 credit card for a year now, and you already missed 1 payment, that means that your on-time payment percentage would drop to 92%, which is gonna land you in Credit Karma's undesirable red line. As you can see, even 1 late payment can hurt your credit, so you need to stay mindful of your due dates. If you want to improve upon your payment history, I recommend that you go ahead and you call your bank and you call your lenders and you ask them that you want to set up automatic payments for all your credit cards and your loans. And if you can't pay all of your credit card balances in full every month, at least make the minimum payment to avoid a late fee. If you do that, you will never have to worry about having a late payment and you'll see your score grow as the months go by. Okay, let's move on to credit utilization, which makes 30% of your score. Lenders typically want to see that you like to spend responsibly and you're not out there maxing out all of your credit cards. If you have a total credit limit of $5,000 between all of your cards and you're using $3,000, you'll be using 60% of your credit limit, which is going to land you again in one of Credit Karma's red lines. Most experts recommend keeping your credit utilization below 30%. But for me personally, I always like to keep it below 10%. If you want to improve in this area, here are my 2 recommendations. Make it a habit to pay your credit card balances more than once every month. That way, your credit card balance never gets out of hand. And second, try calling your bank and ask for a credit limit increase. I do this every 6 to 9 months, and when I'm talking with a bank representative over the phone, I ask them if I could get a credit limit increase without having to do a hard inquiry on my credit. And every time that I've done it, I've gotten away with a 20 to 30% credit limit increase as a soft inquiry, which is great because it doesn't affect my credit scores. The third factor is the length of your credit history. If you're just getting started building credit, there isn't much you can do to affect the length of your credit history. Now keep in mind that this number is calculated by the average age of your credit history and not by the total length of your credit history. Meaning that if you have 2 accounts, one being 4 years old and the other one being 2 years old, the length of your credit history would be the average of those 2 accounts. And in this case, the average of your credit history would be of 3 years. Following that example, I want you to keep in mind that if you go out and apply for a new credit card today and you get approved, that's going to lower the length of your credit history to 2 years. According to Credit Karma, to get the best credit score possible, you should have at least 7 years of average credit card history. And by looking at this picture, you can see that I still have some work to do. There isn't actually much you can do about this one. The only thing you can do is wait on time to pass by and be patient. However, you might want to consider always keeping your oldest credit lines open, because that's the only way to prevent the length of your credit history from shrinking. Even if you have an old credit card that you don't use anymore, keep that account open and buy a cup of coffee every couple months and just pay it off. That way the bank won't close your account due to inactivity. That happened to me with my first credit card that I opened when I was 18 years old. And I stopped using it maybe 5 to 6 years later. So what happened is that the bank decided to close that account because I wasn't using it. And that ended up costing me to lose an account with over 7 years of credit card history. Maybe if they didn't close that account, I could be in the green line right now. So do yourself a favor and don't be like me. Keep your accounts open even if you don't need them anymore. Now let's talk about your credit mix, which if you remember correctly accounts for 10% of your credit score. Basically, lenders want to see that you're able to handle different types of credit accounts, which may include credit cards, installment loans, mortgages, and other types of credit. My best recommendation here is that if you're somebody who's new to building credit, you shouldn't take out a loan just to fulfill the credit mix portion of your score. You can see that Credit Karma ranks you in the green when you have over 11 open accounts, and in the red if you have less than that. So there's no need for you to rush it. Over time, you'll slowly build up this portion of your credit score as you progress through life's big events like buying a car or buying a home. And with that, we finally got to the final factor, which is the amount of hard inquiries you had in the past 2 years. Remember that you're gonna get a hard inquiry almost every time that you go out there and you apply for a new credit card or a loan. And lenders don't like to see that you open multiple new accounts in a short period of time because it suggests a higher risk of you defaulting on a loan. According to Credit Karma, anything over 4 hard inquiries in the past 2 years will put you in the red zone. Therefore, always try to stay below 4 hard inquiries within the past 24 months. And while you need new credit to build your scores, focus on opening just one account at a time rather than multiple accounts at the same time. I want you to grab a calendar and plan out the next 3 to 5 years. Are you planning on buying a house or getting a new car? If so, make sure you spread those important decisions throughout time so it doesn't affect your credit scores and the interest rates you could get. Now, I want you to remember that building credit takes time. You'll end up with an excellent credit score down the line, which is going to allow you to get the best interest rates out there and will end up saving you possibly hundreds of thousands of dollars of interest payments over time. So with that being said, that's all that I have for today, guys. As always, thank you for watching. And if you haven't done so, remember to hit the like button and subscribe to the channel. I'll see you next week, guys.